just for a few minutes to introduce our guest speaker for today, who, alhamdulillah, I'll just go through his profile briefly and then I'll share a little bit of personal experience or my personal views on certain things to do with our speaker, our esteemed speaker today. So Mr. Sani Hamid, he is from Singapore, Financial Alliance Singapore, and he's the director there for economy and market strategy. So we have an economist with us, and not only just an economist in terms of the academic theory, but of course, a practitioner who's been in the financial markets for 15 years. I thought it was for longer, but yeah, seems like a long time, but 15 years. Yeah. And before that, he had good experience as well, a high-level experience in BNP Paribas, Standard & Poor's. And for myself, I started doing Islamic finance or getting involved in Islamic finance in 2012. And at that time, when I just started and I knew nothing, the person that I most wanted to learn from was Sani Hamid, right? Because he was from before that in Singapore until today a champion of Islamic finance. And his expertise is not only in Islamic finance, but also in the economy in general, in finance in general. So we have multiple perspectives that will come into play today. So without further ado, I'd like to introduce, I'd like to hand over this session to Mr. Sani Hamid. And before we hear from Mr. Sani, just very quickly, we will have a presentation. And then after that, there's some questions that are already asked that will be answered. And inshallah, there will be some time left for more open discourse and open discussion. So Mr. Sani, please, it's all yours.
Thank you, Omar. Thank you, Omar, and thank you, Atis, for inviting me to share my thoughts and knowledge about the markets. So over the next probably about 60 minutes, I will give you a full view of what I think about the markets. As I was doing the slides, suddenly I realized that I've got roughly about 60 to 70 slides, and I said I really have not enough time to share everything. There's just so many things to tell you about the way I look at things, my viewpoint. So I hope if I go through it quite quickly or quite fast, if you do miss out on anything, there's always the recording to look back on. Do some research on some of the terminology or some of the angles that I've looked at. So I hope that will help you very much. So I'm going to switch over now to the share screen. Give me a second. Okay. Are you guys able to see the slide itself? Omar, hang on, I need to check the chat. Yes, okay, great. Okay, now I need to close this.
Yes, it's clear.
Okay, great. Okay, again, thank you. Okay. Okay, let's see. Okay, great. Whoops, just a bit fast. Okay, so today we'll talk about COVID-19, of course, and what the outlook is for financial markets by and large. That is my area of expertise. I'm so-called asset allocator at my company. Means to say I will try and understand the markets and then allocate clients' assets accordingly in the markets itself. Just to let you know, the usual disclaimer, or whatever is being said here, basically it's more or less for education purpose. If you need to seek advice on investment, please do seek advice from your respective financial advisors, licensed financial advisors. The agenda today will be, I'll be talking about three segments. And these three segments actually pertain to what we call three different time frames. Let me see whether I can get yes, I can, laser pointer. Okay. The first one is the pre-COVID-19 era or period, which is basically from 2009, the last crisis, all the way until maybe end of last year. And secondly, I will talk about what we call the current situation, February, maybe until June of this year, a little bit of a forecasting here, a little bit. And then what we think will be the future, maybe in 6 months' time onwards for the markets, right? So basically, hopefully this will help you conceptualize the flow of the presentation. It may be quite technical to some listeners, especially if you're not from the market and you don't have a lot of experience in terms of econs and stuff like that. But hopefully, I'll be able to give you a good overview, like I mentioned. And if you do find certain aspects of it a bit technical and you can't catch it, then do go back to the recording and find out the keywords, do a bit of research, and I'll leave you with my email at the end for you to actually come back to me in case you don't understand certain parts of it. Okay, so inshallah, we begin now. Okay, sorry. Okay, let's try and understand first the pre-COVID-19 scenario. Okay, so understanding the past will actually help us to understand where we are today and maybe the risks or the opportunities that lie ahead. The first key thing to understand is since the 2009 crisis, okay, the world is flooded with a lot of money. Okay, so basically this chart itself, when you look at it, it basically represents, in layman terms, the amount of money that's being printed by the various central banks, ranging from the Federal Reserve to the Bank of England, Bank of Japan, People's Bank of China, and the European Central Bank. As you can see, before the crisis, money supply was relatively stable, and that is the mandate of the central bank, to keep money supply stable. But after the crisis, the central banks all ramped up the printing presses tremendously, with quantitative easing 1, quantitative easing 2, 3, and so on. And as you can see today, the Federal Reserve basically at the end of 2014 into 2015 itself had pumped in 5 times more of liquidity than it had before the crisis. And with the BOE 4.5 times, BOJ, PBOC, ECB. So basically what we have here is we have a world which is awash or flush with liquidity. And I call it the fuel of the markets, or the fuel, the petrol that's waiting to be ignited. So basically what happened was the match that actually ignited everything was interest rates. Because interest rates collapsed to historical lows. As we all know, interest rates went down to almost zero for many countries, and even in some countries to negative territory. So you had a situation whereby you had a lot of liquidity in the system. So imagine yourselves having a lot of money in your pockets, you know, and this money came very cheaply, i.e. banks were lending you the money at 1% and so on and so forth. Okay, so what do you do when you have a lot of money and a lot of cheap money? You go around looking for assets to invest in. So you buy properties, you buy stocks, you buy bonds, and every other assets that you can find, Bitcoins even, and so on and so forth. And that caused asset prices to actually suffer what we call asset inflation, and prices went up tremendously. So what we had over the past couple of years is basically an increase in the household wealth. So I'll explain a little bit about this chart. The red line is the gross domestic produce or product, which is basically GDP, and we assume that to be roughly the fundamental of the country, okay, the valuation. And the blue line is basically the household net worth. Households basically hold on to things like stocks and shares and properties. So as these increase in value, then your net worth increases. So you will find that the blue line very often moves above the red line. Just imagine your house. If you go and send it for valuation today, the valuer comes, looks at the house and says, your house is valued at 500,000 Sing dollars or US dollars or whatever the case is. Someone comes along and says, I'll buy it at 900,000 Sing dollars or US dollars, despite the fact that the actual valuation is 500,000. So basically the red line is that valuation at 500,000. The blue line is the 900,000 because situation is so bullish. Everybody's got a lot of money, cheap money. They go around buying all these assets. They don't mind paying a premium for it. Okay. So basically what you see is it happened in the dot-com crisis. What it took was, it took a recession to try and bring it back to what we call fundamental value. Same thing happened, prices increased, wealth increased in the global financial crisis, and it took a recession to almost bring it back to the so-called fundamental value. But because of quantitative easing, because of the exceptionally low, historical low interest rates, the value of assets today are far, far, far away from what we call fundamentals, even further than the global financial crisis and the dot-com crisis. Okay, so the next crisis that we are, and this chart was basically shown, I've been showing it for the past over year. I've been showing it to clients and stuff. So I told them that, we don't know what the crisis is going to be called. So I just put down there MOAC. Yeah, it could be the mother of all crises. And who knows, we're already talking about something close to a Great Depression now. So maybe it's turning out to be the case. But anyway, as you can see, the rally itself has extended for 10 over years since 2009. And now it's really 2020, so about 11 years. And it's really tired in the sense that things don't just go up in a straight line forever. There always has to be what we call consolidation, and that normally is brought about via a recession. And there's a long way down to go, okay? So basically, that's what we are looking at today. So basically, in that 10-year period itself, for those of you who have followed the market, you know that there has been this buildup of excesses. Whenever you have these kind of very long periods of low interest rates, excessive liquidity, you have bubbles building up everywhere. Okay, so I'm just going to go through a few of them because it's important to understand some of these so-called bubbles or excesses, because later when we talk about the future, these are the landmines that basically we have to worry about, because it's in a recession that these bubbles burst. Okay. So the first one actually is basically the huge amount of debt that's in the market, that is basically i.e. borrowings. People have been going around, not only people, countries, corporations, individuals have been going around borrowing money because money was cheap and abundant. You have China debt topping 300% of GDP. You've got the US going around because there is huge deficit that it's incurring, and so on and so forth. Just a point to note, because of the high level of debt, today a lot of countries, if they want to do something called fiscal policy to spend more on COVID-19 and stuff like that, they find that really their debt levels are really very high already. And when they start to spend in addition to these high debt levels, they add on to the burden. And that's where you find, and I'll talk about it later, rating agencies coming in and say, no, I have to cut your ratings because now your debt level has gone from 90% of GDP to 100% of GDP and so on and so forth. Yeah, so it's really a situation whereby debt levels were already very high, and now COVID-19 is causing it to be even higher, especially for governments. Over the past 10 years, like I mentioned, it's not only countries which have borrowed, not only corporations which have borrowed, but also consumers. In the US itself, would you believe that, in the year 2008, the amount of debt that people borrow, you would think that the crisis after that would have taught everybody a lesson. So everybody would be like, no, I'm not going to borrow anymore. I'm going to lever down and stuff like that. Yes, they did temporarily, but today the consumer in the US has more debt than he had during the peak of the 08 crisis, which means probably along the line of lesson wasn't learned, borrow even more. Okay, a lot of it, the only difference is the composition. There's a lot of student loans nowadays, vis-a-vis the mortgage, which was the last time. But anyway, still in totality, the US consumer is highly indebted. And not only the US consumer, but across the world, because again, cheap money, abundant money. And we're talking now before COVID-19, even before COVID-19, we already had what we call cracks that were starting to appear. Again, when you have a situation of too much debt going around, companies borrowing, and so on and so forth, there's bound to be what we call defaults. Companies will default, individuals will go bankrupt, countries sometimes also default. So we are seeing defaults, and China is one of those countries which really had a very bad credit situation, meaning we say, i.e. the companies were borrowing just humongously. So they were already looking at some numbers where there was defaults and defaults and defaults. So that was before COVID-19. Okay. One of the key things which really worried the markets before COVID-19, and in fact the Federal Reserve recently came in to intervene to prevent this bubble from bursting, was the fact that a lot of companies called BBB companies started to borrow a lot of money. In the US itself, as you can see, and this chart itself represents BBB companies, there was this huge surge in borrowings by BBB companies. So the big question is, what are BBB companies? If you understand ratings, ratings are basically a grade given to either a company or even countries to tell investors what is the credit worthiness of this country or company. So if you are an individual, for example, and I give you a AAA, it means that if I lend you money, I have a good chance of getting it back because you're AAA. Okay, you're the best. If I give you, and you're basically a triple C, if I give you money, there's a chance I may not get it back because you are not so credit worthy. So basically, this is representation of credit worthiness, how credit worthy you are. Okay, so there's this particular scale by Standard & Poor's, and of course we have Moody's and Fitch and so on and so forth. In this particular scale, if you are triple B, you are still considered to be investment grade. However, if you fall down one grade, you straight away move into what we call a junk bond or a non-investment grade situation. And it's just one ladder down or one step down. Okay, so basically a lot of companies were issuing and they were all triple Bs. So this particular part of the bond market was just humongous because a lot of companies came to issue and so on and so forth. The biggest problem with that is this. The triple B markets in the US is $4.5 trillion. The junk bond market is $2 trillion. So again, I'm sorry if this is very technical for some of you, but this is really why, if you understand, the Federal Reserve had come in recently to buy up the bond market, and this is really the reason. Okay, so if in normal circumstances, in a normal recession, people expect a portion of these triple Bs to default or to go down into junk status. In a normal recession, you expect about 10%. So out of $4.5 trillion worth of triple B bonds, 450 billion under a normal recession would fall into the junk bond market because they get downgraded. Okay, so you can imagine with this particular number, 450, coming into this particular area, that represents 1/4 of the junk bond market, which means that it's just going to flood this particular market called the junk bond market. And this is with a normal recession, 10% default. People are now talking about in the US having default rates of unimaginable because, you know, companies are going to default, they don't have cash flow and stuff. Yeah? So this was what the Federal Reserve was actually looking to stem, this particular bursting of this bubble. So if you're interested, there are a lot of videos out there, a lot of write-ups out there with regards to the triple B bubble, they call it. Yeah? So if you're interested, do go and have a look at it and do some research on it after this. Okay. The second bubble that was created over the past 10 years was that of the stock markets. This is a very interesting chart. If you look at it, this is a chart for US equities and who are the net buyers of US equities. If you look at it, it's quite interesting because all the lines, except for the red dotted ones, don't seem to go anywhere. Whether it's institution, whether it's household, or whether it's the rest of the world. These are net buying, the net buyers, okay? So that means buying minus selling, this is the net amount. No one was really that strong a buyer in the US markets except for these guys who is the red dotted line, which are the non-financial corporations. Who are the non-financial corporations? They are the stock people on the stock market itself, i.e. the companies. They are corporates. They're non-financial means they're non-banks, non-bank corporations, okay? The Apples, the Netflix, the Microsofts, the Facebooks, and all these kind of things. These are the corporates that were buying back their own shares. And that's why there's this net gain that you see going up from 2009 all the way until now. Okay, so you could infer from this chart that actually the US market underpinning that rally for the past 10 years was liquidity, was low interest rates, but also it was buying by the corporations of their own shares. Okay, and you can see from statistical evidence, when we do what we call correlation, when you put together a stock market chart and you put together a buyback chart, you'll find that it almost moves in tandem 1-to-1, which suggests that buying and stock market going up, both are related or have a very strong correlation. Okay. But again, even before COVID-19, this was coming to an end. They were, you will find the stats showing that companies were waning in terms of their buybacks. Okay, so already this was going on before the market when COVID-19 came into the market. Okay, the third bubble that existed before COVID-19 was the negative interest rates bubble. Okay, would you believe that? I think it's more now, but it's about 6 months ago, it was 30% of global bonds are in negative territory. That means someone issues a bond, you lend money to that person, a year later, 2 years later, 10 years later, you're going to get less money back than what you give to that person. Mind-boggling, but 1/3 of the global bonds were issued in negative territory or are in negative territory. It's probably more by now. Okay, and as you can see, many developed countries' interest rates are in negative territory, and I expect it to go even deeper into negative territory because of the current situation. Okay. I'll just give you an example. The German, this is called a U curve. So Germany had this particular, this is called an interest rate curve or U curve. Part of the U curve was positive and part of the U curve was negative on the 5th of August 2018. 1 year later, on the 5th of August of 2019, the whole U curve, whether you're talking about short-term debt, medium-term debt, or long-term debt, all was negative interest rate. So every bond issued in Germany was in negative territory. Okay, so what's the problem with negative interest rates? Well, basically a few things. Low interest rates itself has a problem. Low interest rates means I've got so much money, I don't know where to put it. You know, I don't mind putting it with this company. It only pays me 1.5%. Never mind, better than not getting any money, better than putting it in a bank and getting very little. So I put my money into this particular company, even though this company is considered to be a double B, even though it is rated to be a company which has a very weak financial position, financial status, I'm still willing to put because I have no choice. So that's one of the key disadvantages, misallocation of resources because of historically low interest rates. That's number one. Number two is the negative interest rate has this particular risk, which I think a lot of people have just ignored or currently just sidestep it. And that risk is what we call the potential for a rate hike. Okay, I'll give you an example. We all know or we've heard of this before. Interest rates go up, bond prices come down. Interest rates come down, bond prices go up. Okay, we've heard of that before. Okay, so if interest rates suddenly spiked up, bond prices would actually come down. So if you're holding on to one of these negative low interest rates bonds, you would suffer a loss if interest rates went up. So this is just a sensitivity table telling you that if you are holding on today to a 5-year bond at -1%, or a 15-year bond at -0.5, or a 30-year bond at 0%, and these are all the German bonds I told you earlier, all it takes is a spike up in interest rates for you to start losing money, which is common because, again, you hold on to a bond, interest rates go up, bond prices come down. But because your interest rates are so low, it doesn't take a lot for you to lose a lot. Meaning to say that it doesn't take a lot for interest rates to move for you to lose a lot. Meaning to say, interest rates just have to go up by, let's say, for example, 100 basis points, which is just 1%. And if you are unlucky enough to hold on to a long-term bond, which is extremely sensitive to interest rates, automatically you lose 25% of the value of your bond. Again, it's technical in nature. If you've done finance before, you understand what I'm talking about. But if you haven't, you just understand when interest rates go up, you lose money on your bonds. And basically, it won't take a lot because for interest rates to move from 0 to 1, it is actually a 100% increase. From 1 to 2, it is a 100% increase. And the magnitude of losses that you suffer is extremely large. So we have this problem here, which is a lot of countries will find that they will be very hard pressed if suddenly there's inflation, and then they want to tackle the inflation by raising interest rates. And then when they look behind, they say, oh no, I've got so many bonds at negative or zero. How am I going to raise interest rates when it's going to hit all these bond holders and so on and so forth? So there's going to be a dilemma if inflation comes into the picture, which is one of the risks potentially. Okay. And one thing about low interest rates is low interest rate kills monetary policy. This is basically the average cut in interest rates that you've seen across all recessions in the US over the past 40, 50, 60 years. Every time there's a recession, the Federal Reserve cuts by 5%, 5%, 4%, 10%, 6%. Currently, the Federal Reserve has already cut, going into COVID-19, interest rates were about 1.5%. They've cut interest rates by 1.5%, i.e. 150 basis point. Interest rates is at 0. We haven't even gone to 5% cut. This is just 1.5% and we're at 0. So if the Federal Reserve were to cut interest rates another 4% to mirror what it did over the past 2 recessions, US interest rates would go into -4% territory. So again, it's really quite tough for a lot of central banks, this low interest rate situation. Okay. So what I painted just now was basically just 2 or 3 kind of things which people in the financial markets know about. Prior to COVID-19, they knew about it and they were very worried about it. And these things are now slowly unraveling. Some of them, the Federal Reserve has come in to support the bond market and so on and so forth. But as we go along, in the months ahead, you may find some of these landmines being stepped on and starts to blow up. So that's one of the key worries we have going forward. But we'll discuss that later. Now we're still in the pre-COVID-19 scenario. So when we entered into 2020, the global economy actually entered in at a very weak footing. When you look at all the countries in the world, and if let's say, for example, I stacked up the top 10 countries in the world, and the first 6, I cut it off, the first 6 actually represent 55% of the world's global economy. I'm, over the next few slides, going to run through very fast, and I'm going to show you the headlines of each and every one of these economies in 2019. So these headlines appeared in 2019, okay? Because we're talking about the pre-COVID-19 era. In India, slow down, shock, worried, slow down. You see these words coming out. In the UK, maybe in a recession already, suffered the sharpest contraction. In Germany, economy hit hard, recession, so on, slow down, so on. In Japan, again, words like downgrade, 3-year low, slow down, output falls. In China, slowest economic growth on a quarterly basis since the last 27 years. That means last year, the quarterly growth, you didn't see this level. The last time you saw this level was 1992 or 1993. Okay? And here, China, the growth, industrial growth is 17.5 years low, so on, so forth. Okay? And of course, when China sneezes, everybody else, the smaller economy also sneezes. So even Singapore's GDP was wobbly last year, Korea's one similarly, and so on. Okay? And of course, the United States, which had been the so-called only country which kind of showed a positive expansion because of all the liquidity they had and the low interest rate they had. The economy was expanding, although not at a rapid pace, but still sustained the expansion for a long time. It was the longest expansion in the history of the US. But again, it also was showing at the end of last year what we call indications that the economy was also tired, becoming very tired and slowing down. Just look at some of these charts. And these charts are not COVID-19 charts. These charts are basically before COVID-19. So you already see that what I'm trying to say is that we entered COVID-19, the world entered COVID-19 in actually a very weak economic situation. Even the corporate sector in the US was already, the earnings were considered to be very low, expected to be very low. The earnings per share had dropped from 170 odd to about 160 middle of last year. And so again, it wasn't a pretty story going into COVID-19. The rest of the world, same thing. The UN was forecasting low growth. People were worried about a recession and so on. So what more so now with the situation with COVID-19? Okay, again, this is just indicators of the GIC, and many people were really saying late cycle, late cycle, late cycle. Late cycle means there's an economic cycle. We are at the last part of the economic cycle. So this was more or less the situation that we're in. Okay? So what happened was many central banks last year started to cut interest rates. As you know, when there's a recession or when there's threat of a recession or when your growth rate declines, the authorities do one of 3 things. First of all, they cut interest rates to stimulate consumption, or 2, they start spending fiscal spending to try and boost what we call economic activity, and sometimes they also depreciate their currencies. Yeah. So, but basically, central banks last year, the arrows here, I'm sorry if you can't really see, but these are the names of the countries and where their central banks actually cut rates. Those are the arrows that move to the left-hand side. Okay, so a lot of central banks acted by cutting interest rates. And also last year, we had, those of you in finance would have heard about the inverted yield curve. Every time this particular indicator goes into negative territory, it is followed by a recession, which is the gray. So it went into negative territory, which is the blue line, then became recession. Blue line, recession, blue line, recession, blue line, and then was expected to show a recession in the US. Again, what I'm just trying to tell you is when we entered 2020, even before COVID-19, the global economy, including the largest economy, which is the US, was already on a very weak footing. Okay? So So I've kind of given you a very quick indication of past 10 years, what's been boosting growth. We've reached more or less the tail end of that cycle. Therefore, growth was already tapering off. But in between that, they had a few excesses, a few bubbles building up. Okay, so now you have an idea that when we entered into COVID-19, basically this was the situation: weak growth, bubbles here and there. Yeah, so and pretty weak situation overall. Okay, so right now, if you're an investor in the markets, you see the markets coming down 20 or 30, 35%, and this is basically the S&P, and now the markets have rebounded. So basically you're asking yourself the question, have we bottomed, or is this what we call a bear trap and the markets can go down lower? We have assigned a probability. We think there's just a 30% probability, 1/3 chance of markets actually bottoming and going up, and a 2/3 chance of markets actually coming down. So a higher probability that markets really have a bit more downside to go, and I'll explain later why that is the case. Always remember, if you are in the markets, if you're an equity investor today, you may be enticed to go into the markets, but we are telling our own investors, beware, because why? Even in every bull market, in every bear market throughout history, there has always been what we call a fake bull or a bear trap in between. There always, see, for example, in 2008, market came down 20% and then rallied 15, and you had a huge decline after that. Same thing in 2000, market came down. If you rallied 21, if you thought it was the bottom, you got in again, and then after that it went down. Same thing with the Great Depression of 1929, down, up, and then went down. So again, it just shows you that while the market can rally, it doesn't necessarily mean there's a bottom in place. Okay. So if you're a bull, basically you're quite bullish today, because one of the key things is the Federal Reserve, which is the Central Bank of America, came in and really did a lot of things, kind of like a shock and awe strategy. It came into what we call the fixed income market, which it traditionally doesn't do so, only in crisis it does so, but it did so many things in the fixed income market, supported it. It came in to support the real economy by giving all these packages to SMEs and so on and so forth. So all in all, it's throwing a lot more money into the system to try and support the economy, because we are truly in what we call an unprecedented type of economic slowdown. You've never seen, I've never seen, I think no one has ever seen this type of shutdown across so many countries globally for such a long extended period. Yeah, so again, what the Federal Reserve is doing is basically the same as many other central banks, is trying to save their respective economies as much as they can. There is some rumors that the Federal Reserve, later I'll talk about it, if they do not get to push the economy higher despite all these things, will try and move in to buy stocks. Okay, and we'll talk about that a little bit later. There is also this euphoria now. I think President Trump just mentioned about the epidemic curve peaking and so on and so forth. This itself is from the Imperial College of London, which is a very famous medical school in the UK. So they actually came out with a report, I think about a month ago or 6 weeks ago, highlighting that the epidemic curve itself, if nothing is done, would actually look something like this. But guess what? All epidemic curves, whether you flatten it or whether you leave it as it is, will eventually come to an end. It's all a bell curve. So basically, the end of the first wave of COVID-19 would actually fall somewhere between August and maybe even extend to September, where cases go down to single digits and stuff. But the peak would always be somewhere around June or maybe even July. Then after that, it starts coming down. Okay, so we're beginning to see that. The market isn't really very surprised. There are some people who are surprised by it, but this has been known for the past 1.5 months. I'm just trying to say that actually, if you're positive on the market, you're positive because of Federal Reserve intervention, and you're positive because you hear news about lower death rates and what we call we're moving past the peak. Okay, so these are the two things which a bullish investor would feel. The Federal Reserve, this is the amount of money. This is the same chart I showed you together with all the Bank of England, Bank of China, and stuff like that. Okay, but this is just the Federal Reserve. This is quantitative easing 1. They printed $1.5 trillion. During quantitative easing 2 and 3, they printed $2.09 trillion. And recently, in a very, very short period of time, they printed $2.3 trillion. You just look at the balance sheet of the Federal Reserve and you can tell that today they have printed just so much more even compared to the last time, the QE1 and then QE2 and 3 combined. Okay, so they're doing a lot of things to try and support the markets. This chart is just a combination of the printing of money, the Federal Reserve balance sheet, and the stock market. And so you can see from here more or less, when they start to print money, the stock market goes up. When they stop printing money, stock market moves sideways. And this number 3 here, and I'll explain it a little bit later, is a bit unique situation. Despite the fact they didn't print money, the stock market went up. Okay, and I'll just explain it quite quickly after this. Okay, and today, because they printed even more, the latest chart is like this. So that's why people are bullish. They say that, wow, if this is the case, the correlation between printing of money and the stock market is so tight, then therefore, if they start to print money, then by right, the stock market should also go up. Okay, that's the bullish case, which we only have a 30% belief or probability on that. Okay. So I've showed you this previously. So basically, the stock market is going up because of share buybacks. Remember the phase 3 where I said that despite the fact that the Federal Reserve didn't print money and the stock market went up? Well, there's a reason behind it. Well, it was somewhere between 2017 to 2018. Trump won the election in late 2016, announced huge tax cuts. Companies suddenly found themselves in 2017, 2018, more or less 2018, with huge amount of money left behind because they didn't have to pay tax or paid very low tax. They were also given incentives to bring back money from offshore. So they found themselves, I've got money from the lower tax I'm paying now. I've got money from the bringing back offshore. What do I do with it? I take the money, I go buy back my own shares. Okay, and that actually propelled what we call the share buybacks even more. And you can see from here, the chart here, this is a share buyback chart here. It just jumped up in 2018, 2019 because of what I just mentioned, both the tax cuts and also the repatriation. Okay, so even though the Federal Reserve didn't print money a lot that time, the tax cuts and the repatriation actually allowed corporations to have a lot of money because they brought it from elsewhere and they didn't have to spend on tax. Okay, so people who are bullish on the markets will tell you that we expect a V-shaped recovery. And what is a V-shaped recovery? If you look back at Black Monday in 1987, when the markets fell 36% in 2 months, it recovered after that in a 21-month period of time, when it moved back to what we call back to the highs of the crisis or prior to the fall in the markets. Okay, so the V comes from this part here. You see the V here. This is a V-shaped recovery. So I call this a V-shaped light. Light meaning to say that it didn't last extremely long, 2 months, 21 months. Okay. So what I've done is, this is where we are today. Okay, I think this was a snapshot, I think about a week ago, a few days ago. If we have a similar Black Monday situation, what you will get is this. We have actually hit the bottom, and from now on, we will be moving up from here because that was what happened in Black Monday. In Black Monday, markets fell by 36%. In today, markets have fallen already by 35%. So therefore, that part done already, markets will go up from now. So if you are a firm believer in recovery in the markets, that means you are a firm believer that today's markets is a reflection of what we call Black Monday. Okay, simple as that. However, we don't think so. We think that actually, for example, the Federal Reserve, the correlation between pumping in of money and then the money translating into higher stock market prices, we think that's a bit shaky now because the bridge, the thing that has moved the quantitative easing money into the stock market was the thing I called stock buybacks. Company buying back their own stocks. Company buying back their own stocks. Apple buying back their own stock. Netflix buying back their own stocks. Okay, the estimate is that particular buyback is going to reduce by half this year. Okay, and there's a reason for it. There are two reasons for it. There's and it's stated in the FT article: employee layoffs and political and social pressure. And I'll go through it. Already, you see the headlines. You realize that many companies have already ceased and delayed their stock buyback. Okay, and that's going to be detrimental to the markets moving higher and higher because without the Federal Reserve liquidity being bridged over to the stock market via stock buybacks, then how do you move that money into the stock market? Okay, so one thing is the Washington has actually introduced a $2 trillion package to help with the COVID-19 situation. Any company who takes this package, a loan, temporary loan, bailout, or whatever the case is, you're not allowed to do stock buybacks for at least 12 months after the loan is repaid. So you take the loan, you spend time to repay it, and then after that, 12 months after that, you still cannot do stock buybacks. So, and a lot of companies are taking it. So companies which used to do stock buybacks now are prevented from doing stock buybacks because they've taken part of this assistance from the fiscal package. Number two is stock buybacks used to be, in one part, used to pay employee compensation, meaning to say Apple, Netflix, Microsoft, apart from giving cash to the employees, gave them stocks. So basically buying the stocks from the market, in a very simple term, this is just a very rudimentary way of looking at it. They bought stocks from the market and they gave the employees that stock. Okay, that's the stock compensation. But today, if your employees are either, number one, not getting a pay increase, number two, you're not hiring anymore, number three, worse still, you're even firing employees, then basically the stock buyback situation is not going to exist. So you got two situations here which suggest that stock buybacks will actually start to go lower and lower and lower in the months ahead. So we do believe that actually if you're arguing for a V-shaped recovery because of all the quantitative easing, money is going to make its way into the stock market is going to boom because of all the quantitative easing, you would have to convince me that there is a mechanism whereby the liquidity will make its way into the markets, and therefore that mechanism, stock buyback, has resurfaced again. But if it's weak, then I don't think so. Okay. And that's why I think eventually what could happen is when the Federal Reserve looks at this and says, I've printed so much money and yet the stock market is not going up, the Federal Reserve may come in to start buying stocks. That is something which the market is speculating about. Why is it so important that the stock market needs to go up? Because 70% of global GDP in the US is basically household consumption. GDP is gross domestic produce. It is a measure of consumption. So if you can get 70% of your household to consume, to spend, yeah, then what happens is growth will come back, GDP will increase. Okay, how do you get them to spend? They must feel wealthy. How do you get them to feel wealthy? The assets they own must increase in price, whether it's stocks, bonds, or property. So the stock market is one of the easiest way. Stock goes up, you feel wealthy, you spend more. So eventually, I think the Federal Reserve could eventually come in to buy stocks, and this is not unprecedented. Japan has done it before. Yeah, so let's look out for that. We're still early now, but let's look out for that. If you don't think that the situation will be kind of like a very shallow V-shape, it could be a sharp, deeper V-shaped recovery. Okay, and that sharp, deeper V-shaped recovery would be like the global financial crisis, when stocks fell 58% over 17 months and then took 48 months to recover back. So today it looks like this. Today we are here. If I superimpose a global financial crisis situation on today's scenario, it would look like this. That means stocks will probably have a little bit more, not a little bit more downside to go, probably until the middle of next year before it recovers and then slowly recovers. Okay, so that's superimposing what we call the global financial crisis onto today's scenario. What would be the situation that would be in line with this? Well, basically, I'm going to talk about the future now because we're starting to look into the future already. I think it's more likely, and I showed you the V shape just now, but I personally think it's more likely to be a U shape. Okay, so basically, when did the U shape happen? The U shape happened in the dot-com crisis. As you can see, it wasn't straight down, straight up. It was down, and then there was a bit of consolidation here, and then only then it started to move up. So there's this a little bit more of a curvy type of recovery, and that's why they call it a U shape. It took longer to decline, and it took longer to recover. Okay, so at this particular point, I'm more inclined towards this happening. Of course, no one knows, but again, this is just a projection. So what are the things that will potentially cause a U-shape? I think it's because of a few things, and I'm going to try and explain this subsequently in this next few charts. One is I think the markets or a lot of people don't understand that actually this economic impact is not going to, it's going to last much longer and it's going to be much deeper. Okay, why do I say that? Already from a number perspective, we are seeing a huge decline in all the data. Oh, I do apologize. This one is the forecast for the IMF. The IMF made a forecast in January, and they forecasted 3.3% global GDP positive. This should be April. Sorry, it's not February, it should be April, and I'll change it later on. So this should be April, okay? So in April, after COVID-19, now they forecast minus 3% for global GDP. So from forecasting positive 3 to 3.3 to now negative 3 for global GDP, it is a big thing. It is unlike what an individual country, when an individual country forecasts 3.3 to minus 3 is bad, but it's not as bad as when you talk about global, because global GDP is an aggregate of many, many countries, US, China, Europe, Singapore, whatever the case is. Okay, you add them together, you get this kind of average 3.3. So when you are changing a 3.3 all the way down to minus 3, you're saying that every component in that aggregate is going down and going down sharply. The whole world is decelerating at a very fast pace. Normally, global GDPs don't move a lot because most of the time you find that certain countries increase, certain countries decrease. The US is growing, Australia is declining, Europe is growing. So when you add them together, they tend to average out. So movements in global GDP forecasts don't really move a lot, honestly speaking. But when you see something moving from 3.3 to minus 3, that goes to show, as I mentioned, the whole globe, the whole country itself, all the countries are actually decelerating rapidly, simultaneously, very fast. Okay, so really it shows you that this thing is really quite dire in a sense. Okay, so when countries decelerate, and you remember we had all these bubbles and stuff like that. So when countries suddenly decelerate so fast, there are a lot of risks. You just cannot. You know, when you drive a car at a certain 80, 90 kilometers and you suddenly stop the car and you know, you jerk forward, there's, you know, you if you're not wearing your seatbelt, you could injure yourself, and the car behind you could just bang you from behind and stuff. So when you decelerate, that's the thing. You'll find that a lot of things in the economy just cannot take that deceleration, especially if it's a sharp deceleration. I'll talk a bit about it. So number one is, I think the world doesn't understand fully yet what is the post-pandemic or post-COVID-19 situation. Everybody thinks, not everybody, but most of the reports I read tend to think that, okay, come August, when the numbers all go to single digit, after that, the economy will slowly pick up and then we're going to be fine, we're going to go back. The fact of the matter is, until we find what we call a vaccine, and a vaccine will probably take 12 months to 18 months. Some people now say that maybe it could be less than 12 months. We don't know, okay? But typically speaking, 12 months to 18 months is the normal time frame for a vaccine to come out, okay? Until we get a vaccine, the world will not be going back to its normal activities. You and I, I'll give you an example. Let's imagine that you and I, Alhamdulillah, after this, we have not been infected with COVID-19, okay? And then after that, the lockdowns are lifted. Would you go and travel? For example, myself, I used to travel to Kuala Lumpur a lot and so on and so forth. Would you take a plane and travel to wherever you typically would travel? Would you go on holidays with your family and so on and so forth? No, I don't think so. Because why? Because if you're not infected and there's no vaccine, there's a high chance that the virus is still there around and you can't see it and you could be actually infected by it. So social norms will change. Not only are we going to wash our hands more, we're going to travel less, we're going to socialize less outside and so on and so forth. Okay, we're already seeing that in China. China has come out from the lockdown earlier than everybody else. And some of the small restaurants, the restaurants, the SMEs and stuff, they're really saying business is terrible because social norms have changed. People don't go out and eat because they're afraid the virus is still around. Okay. So I think this thing itself, I don't think the markets really have understood it. So markets tend to think that it's just a switch on. Once it's finished, I just switch on and everything is going to be fine. I don't think so. Okay. And the damage that's being done now, it's not easy to actually get out of it. You know, it's one thing when you don't have salary and then you need to pay off all your debt, and then you go into a huge amount of debt. Just in order to get out from that debt itself, it's not as simple as, you know, after I start work, everything is going to be fine. No, you're still going to be saddled with that debt. And it will take you months to save up money to pay off that debt in order for you to have confidence again to come out and start spending and so on and so forth. So again, these kind of things will have a drag on the economy, which again, I think many people have not really factored that in. I think there could actually be, for those of you who are in the markets, you'll probably be familiar with price earning. I think there's going to be a re-rating of price earning. Price earning is basically price over earning per share. Okay, how people estimate the value of a market, they just say, again, forgive me, it's technical and you can search this up after this, EPS of $130, okay, times average PE of 15 to 25, this times this will give you a value of your S&P 500 between 2000 to 2006. Fine, that's a value. But now with COVID-19, your EPS is no longer 130, your EPS is 100. Not only that, people are saying, why should I pay 15 to 25 times PE for a situation where companies are not earning a lot? Have you gone to look at a movie theater booking website recently? If you go in, what you'll find that every seat in between other seats, there's an X, i.e. you can't book it. This thing will continue even after August, September, and so on and so forth because the virus is still around. Which means even if everybody went into that movie theater, whether it's KT or Shaw or whatever, the person running that movie theater would never be able to fill that movie theater 100% anymore because there's one seat in between every seat. So basically he'll get 50% of revenue. So that in my view is a re-rating of the market's ability. You can't earn 100% of revenue which you used to earn last year. Today you're going to earn only 50% of revenue for the next couple of months or even 1 year from now. So a re-rating will say your new PE is actually 12 to 17. So 100 times 12, 100 times 17, this is the range of your market. This is the value of your market. So basically what we will have is we will have the markets coming down because there's a re-rating. A bit technical, those of you in the market would understand. Those who are not, please do some research and probably you'll get to understand. Okay. I did mention earlier that basically a lot of this borrowing from countries will bring their debt levels to very high levels. It's already happening, and the rating agencies are cutting their ratings. Meaning to say that you've come up with a COVID-19 package, you've incurred more costs now, your debt has increased as a percentage of GDP. So I have to reduce your ratings because you're no longer as credit worthy as prior to this. Okay, and so that's happening. So we see a lot of downgrades in terms of sovereign ratings, and sometimes this could lead to crisis because sovereign ratings basically are indication of a country's ability to borrow. When you reduce that ability to borrow, they start paying higher interest rates to borrow. Their currency sometimes come under pressure, and so on and so forth. And if those of you who are a bit more advanced, when you understand the Federal Reserve balance sheet, you'll realize that they're starting to buy things like, excuse me, they're starting to buy things like high yield corporate debt. So sitting inside the Federal Reserve balance sheet is high yield and corporate debt. If there's a recession, the high yield and corporate debt could actually default, which means the Federal Reserve starts to lose money on things that they're holding on to, that it's holding on to. That actually erodes the Federal Reserve's credibility because it is now taking on market risk. Okay, again, a bit technical. Those of you in the market, you understand. So this is also something which is what we're looking at from the market perspective. So, having said that, if really it turns out that today we are moving into what we call a U-shaped recovery, not a V-shaped recovery, how could things turn out? I'm taking .com and I'm superimposing .com onto today, and this is how it would look. Therefore, we don't bottom out in 2021, we actually bottom out in April 2022, okay? And then it takes another 4 years before we reach back above the highs that we saw in February 2020, which was just about 2 months ago, okay? Now comes the interesting part. Okay, what if a black swan happened? A black swan, for those of you who don't know, is this kind of what we call low probability, high impact scenario. The probability of it happening is low, but if it happens, it's a big impact. COVID-19 is a black swan because it's the probability of a virus was getting higher and higher, but still considered to be very low. But a virus to shut down the whole world was a really low probability, but it happened. Okay, so that's a black swan. Could we get more black swans? We could. And I think one black swan, which is basically, and I wouldn't even call it a black swan, it's probably something which is quite high probability of happening, is onshoring. What is onshoring? Onshoring is where manufacturers bring back their factories onshore to where they are. The US, Nike in the US, Apple in the US is going to say, I'm going to shut down my Chinese factories. I'm going to bring back my factories from China and start doing them locally in the US itself. Why would they do that? Sometimes it's out of pressure from the governments, because the governments are now, unemployment rate is very high. The governments may say, we want you to build the factories, bring back the factories so that the citizens have employment and we can bring down the unemployment rate. Okay, so that could be one thing. There could be other things because of countries like China now, they become more nationalistic, harder to deal with. So basically you bring it back onshore. Okay, but when you bring back things onshore, then something happens. One is prices go up because you're no longer building or putting together your iPhone in the cheapest place in the world, which is i.e., for example, China. So therefore, when you start manufacturing in China, it only costs you $100 cost price for your iPhone. You bring it back to the US, it's going to cost you $600 cost price. So automatically, your core inflation or your inflation numbers will start to go up. And there's, of course, ineffective use of capital. Okay, so again, what we expect is if this thing starts to happen, then you will see inflation starting to move up. And in an environment where the economy is slowing and you have higher inflation, you get what we call stagflation. Okay, so this is again something that we are looking out very closely for. And another big black swan is since we don't have a vaccine, the virus could come back a second time, and what we call a second wave. I'm not trying to frighten you or anything, but basically just saying this is a low probability, high impacting. Because in the Spanish flu itself, the first wave was here in summer, and in winter a second wave came, and the second wave was much more virulent or much more higher fatality than the first wave. Okay, so this is something you ought to look out for. Keep it at the back of your mind. And if that happens, if we are hit with what we call a black swan, what could happen is we could then see the global economy, which is already struggling, and you hit it with a second big hammer, and therefore you just get a KO, a knockout. Okay, that happened in the Great Depression, where stock markets actually fell 86%, took a W-shaped recovery, a new alphabet W, okay, and then took 268 months before it recovered back to its previous high. And in between suffered a World War II, for example. Okay, if we took that same scenario, what you'll find is today you could see the markets actually tumbling very sharply and taking really a long time to recover. Again, I'm not saying this is the actual scenario that's going to turn out, but I'm just saying, I'm just superimposing to give you a visualization of what could happen if we did have a black swan and so on and so forth. Okay. Okay, so I've actually more or less come to the end. So I've given you more or less what the past was, the present, and what the future could hold. Okay, I've put a lot of my thoughts. I've taken a lot of my thoughts from videos which I've posted on our Financial Alliance YouTube channel. Please go there. All these videos are available for public. We have certain videos which are only for our clients, but these are the public ones. And then you'll gather some of my thoughts there on the whole situation. Okay. We can move on to the Q&A segment. I put my email there in case some of your questions I don't answer and you want some answer, you have different questions or you're shy to ask and so on and so forth. But we have received quite a few questions prior to this. I will first go through some of these questions. I think the bulk of them were answered in my presentation itself. But I think some of them I found it interesting, and I'll try and answer some of these questions. And then after this first 10 minutes of answering these questions, hopefully, inshallah, and we'll leave about another 15 to 20 minutes for the online questions that you may have. Okay, so let's try and answer some of these initial questions. How does one invest in this type of scenario? We had that question. Okay, so very quickly, we favor what we call dollar cost averaging. Dollar cost averaging means instead of putting all your money in as a lump sum, you actually now divide it into 6 installments, or you divide it into 18 installments, or you divide it into 24. It's really up to you. We think that an 18 to 24 month installment, it means about 1.5 years to 2 years installment, is probably what we are comfortable to ask our clients to do. If the scenario, so what we did was we took this kind of a, if you go in lump sum, if you go in 6 months dollar cost averaging, if you go in 18 months, what would be your buy-in average price if it turned out to be a certain scenario? So we did this kind of modeling, so to say. Okay, so if really the market was actually recovering very sharply from here, then our recommended dollar cost averaging would see you having an average price, because you buy like 1 month, 1 month, 1 month, 1 month, 1 month, 1 month, all the way 18 months, your average cost would be much higher than if you had gone in one lump sum. Okay, but because this is not our scenario that we think of, therefore we think that, you know, this is really not the strategy that we want to apply for this case. This 18-month strategy is basically for this kind of cases, because when you start buying on the way down, market goes down, you buy, market goes down, every month you buy, every month you buy, every month you buy, every month you buy. And if you buy it for 18 months and the decline is also for an extended period, then you get a very good average, 1995. If you lump it all together in 6 months, you have $100,000 every month, you divide by 6 and every month, then half a year you're done already. You have the risk of your average being still very high, because why? Market continues to fall. Okay, so we think that an 18-month dollar cost would be something which is useful. Same thing, we applied it to the dot-com scenario, and the 18-month dollar cost came out the best because it captured a lot of the downside and gave you a very good average entry point. On average was 2311. Okay, the only time the 18-month didn't really work was basically if the market fell into what we call very deep recession. Okay, but again, by the time we come all the way, let's say up to here, let's say we've already spent 8 months, we still got another 10 months left. What could happen is we can say, oh, let's not put the additional 10 months into the market. Let's hang on for a little while because things look really bad. So we wait, and then we just go back into the market at a later stage. So 18 months will actually give you this flexibility of doing so. Because if you do only 6 months, you spend it ready, then you have spent all your ammunition, all your bullets, and basically that you just have to ride the whole market down and up. Okay, I hope you understand a little bit about what dollar cost averaging is. Okay, we come to the more or less the practical questions. Are Sharia funds doing better than their conventional counterparts? How are Sharia compliant markets affected by COVID-19? Okay, I'm going to show you a few things. The general answer is it depends. Sharia funds versus their conventional counterpart, because there are segments of the Sharia market which compete with their conventional counterparts on what we call slightly different parameters, and some of them with slightly same parameters. And I'll give you an example. Okay, so this one is we have this taken from Malaysia Unit Trust. Okay, RHB here. This is again, for example, for education purpose. I'm not promoting any particular fund, but it is for education purpose. So RHB China Fund, for example, since year to date, that means from the beginning of the year until today, okay, which is represented by the green line here. As you can see, actually it's done a lot better in this period compared to its two other counterparts, which is another China fund, which is another China fund. So you could argue, okay, I haven't really looked into it, but one could argue that maybe it's because, again, Sharia compliant stocks, one of the filters is you cannot have too much debt. So basically, this is the market rewarding companies which have lesser debt than other companies. That means, i.e., in this kind of deleveraging environment, I would tend to buy companies which have better balance sheets, less debt, you know, don't have too much borrowings, and so on and so forth. Okay, so this could be a reflection, and this is where I say there could be slight differentiation in parameters which cause the Sharia compliant fund to be better than the non-Sharia compliant fund. Okay, but there are instances where the Sharia compliant fund follows exactly the markets. So basically, this is a bunching up of what we call the gold funds. No DWS, Deutsche No Precious Metal is the Islamic one. Okay, and if you just look around, you can't even see which one it is. Oh, it's actually the blue one. It's just stuck somewhere in the middle here, which means that it just follows the market. Why? Because by and large, the holdings of all these funds are almost the same, because this sector, the gold sector, they all share more or less the same characteristics in terms of leverage, in terms of exposure, and so on and so forth, in terms of holdings of cash and stuff. So they all qualify more or less based on the whatever rule book you use, and therefore they tend to move together. So there's less differentiation when it comes to this kind of Sharia compliant funds. Okay? And there's a situation whereby if we talk about, let's say, Sukuk, because when you talk about Sukuk fund, then it's a bit more tricky, because you don't have that variety in Sukuk that you have in the conventional bond space. In the conventional bond space, I have high yield, I have high grade, I have money markets, I have short duration, I have, those kind of things. Well, when you talk about Sukuk funds, you typically normally have just a Sukuk fund. And the Sukuk fund, when you look into it, it is a mixture of what we call high grade and low grade. Why? Because in the Islamic world, sukuks are issued by Malaysian, Indonesian entities, for example, and these are more or less investment grade. But when you move over to the Middle East, you'll find some countries there are non-investment grade. So most sukuk funds are a mixture of an investment grade and non-investment grade, which you do find some of these type of funds in the conventional world, but quite rare. Okay, conventional world, they tend to just differentiate investment grade, non-investment grade. So well, Sukuk is more or less in the middle. So it's no surprise to see that if you look at the Sukuk one, which is basically the red color one, it doesn't really move in line with the conventional, because again, the characteristics is different. Yeah. So I'm trying to just to answer the question, because there's no right and wrong, yes and no kind of answer to this. Okay. How do you gauge the impact of COVID-19 on the Islamic financial industry? Okay, the answer is this. I hope that this COVID-19 trigger to the global economy, because we're having this massive deleveraging, massive debt situation. Everybody's grappling with the amount of debt that they've had, regretting that they've taken on so much debt, that it will lead to a rethink of the whole situation with regards to debt. Meaning to say that with the global market, especially the conventional side, has been so, debt is good, debt is good. Why? I take on more debt and then I can use that debt to create more assets and so on and so forth. Not realizing that when the market falls, that debt comes back to haunt you. Okay, so this kind of realization, sometimes it takes a crisis for it to happen. I give you an example. In 2009, when the 2009 is like when the crisis happened in 2008 and 2007, right? The global financial crisis. It actually sparked this kind of what we call movement to go and redefine and ask. The market was asking themselves. President Sarkozy in France actually asked a whole panel of Nobel laureates. Do you really think that GDP is a good indication of growth, or a good indication of our welfare? Because GDP is gross domestic produce. You produce something, GDP goes up. So should a country actually use GDP as a measure of success, a measure of progress? And the answer was no, because GDP doesn't capture things like, for example, if you start to work 12 hours a day instead of 8 hours a day, GDP goes up. If you start cutting your trees down, GDP goes up. If you start polluting your environment, GDP goes up. Because again, GDP doesn't capture what we call these negative externalities. Yeah. So that kind of thing started to evolve because of the crisis of 2009. So what I hope is the current crisis will then start to have people think, is that really something that we ought to be promoting? Because it's really something which is very painful when it comes to a crisis. So the current crisis will put in the forefront dangers of debt, leveraging, over-leveraging, and over-consumption. Okay? But if any organization, if any individual was truly following the Islamic teachings with regards to debt, over leveraging, and so on and so forth, you will find that that particular institution or that particular individual, by right, in this current deleveraging environment, debt destruction environment, and so on and so forth, would actually come out on a better footing. Because why? Because Islam says you don't borrow unless it's necessary. And if you have debt, then you ought to try and pay it off as soon as possible. So basically, our balance sheet as a Muslim ought to be what we call minimal debt only necessity, you know, then we only take on debt. Otherwise, we don't take on debt for any other particular reason. So when this crisis comes, we don't go to work, we lose our jobs, our salary gets cut. We don't face the same situation had we taken on massive amount of debt. Okay, so by right, this crisis could differentiate people who are highly indebted and people who are less highly indebted, and we ought to be in the latter group. Okay, that's the question I'm trying to answer. Second one, how can Islamic institutions help in recovery from this crisis? Compassion. Because again, I think this is, I think Islamic banks, for example, financial, this is really a good time to show that compassion is part of the Islamic tradition. Okay, already countries are coming up or telling people, no, please give some time for these people to pay. That's very Islamic, right? Because again, Islam says, if your borrower cannot pay, then you give your borrower time. Eventually, if your borrower cannot pay, then of course you write off the debt, if you knew what is good for you. Yeah, so basically that's very Islamic. Okay, don't even get to the point. What do I mean by this? If you're an Islamic financial institution, you ought not be lending money to the same extent that a conventional, in my view, into a conventional bank or financial institution, whereby you're encouraging leveraging debt. Your client is taking on debt. And you ought to be there and say, no, basically, as a Islamic financial institution, I can only extend to you a certain amount. I'm not going to go beyond that, even though you, under conventional circumstances, you qualify for it. Because I'm not going to promote leveraging or debt increase of debt. Even though it's an Islamic debt, for example. Yeah, because I've heard of people saying, you can buy 10 homes, never mind, as long as it's an Islamic financing. I don't think that's correct. Okay. And it's not about shareholder value anymore, maximizing utility anymore. Yeah, I think this compassion. How COVID-19 has positively affected Muslim communities. Again, this is what I'm trying to say just now. It will actually differentiate. And I hope, inshallah, I hope that really people will start to find that, hey, how come you still are okay? You're not really affected. Well, because I didn't over leverage. I didn't go and buy that 2, 3, 4 properties thinking that I want to maximize my utility and trying to make my first million. I was more or less contented with what I have. Not only that, but I still invest everything, but I didn't leverage it up. And therefore, I'm not suffering from it. Yeah. So I think we could have that kind of differentiation from this particular crisis. With the printing of fiat currency, how would one survive this constant printing of currency? Well, I want to tell you that it's not only the printing of currency, this whole system, and I think most of you who are studying Islamic finance will agree with me, it really differentiates and really makes the rich and poor, the diversity increase. These are just Oxfam headlines for past few years. In 2015, 1% will own the rest of the world. In 2016, 62 people will own the same as half of the world. And in 2017, 8 men will have the same wealth. And I think now, if I remember correctly, it's down to don't know how many men and stuff like that. So it tells you that the system we have today is one which actually perpetuates this Gini coefficient, yeah, between the rich and the poor. One thing I think I want everybody to realize also is with regards to the current system that we have. The current system that we have promotes crisis. You cannot run away from crisis when we are in the current economic system, which is a boom and bust system. The only way you can equate back assets and liability is through a bust, i.e. a recession, and sometimes it can be deep. And you just look at the 21st century recessions. We've just had so many recessions after, or not recessions, but crisis after crisis after crisis. And the next slide, I will tell you why we have such things, okay? Okay, let's do a very quick analysis of this, okay? Imagine today, in this world itself, you, the viewers today, I think there are about 150 of you, myself, okay? We live in the world, and the world is you and I, okay? 151 people, for example. The number of currency or money in this world today, okay? Let's say I print 2 trillion worth of currency, okay? Or me and a few central banks, we have 2 trillion worth of, not 2 trillion, 200 trillion worth of currencies, okay? Which is 100 trillion plus 100 trillion. For one group of people, they borrow this 100 trillion and they leverage it up by 5 times, okay? And they pay an interest of 5% on this particular borrowing. For another group of people, they don't like leverage. Never mind, they just take 100 trillion and they say, I will actually borrow from you at 5%, okay? So after 1 year, this group, which actually borrowed 100, leverage it up 5 times, now has to repay back what we call the 5, or rather the amount, the total amount is 525 because of the 5% interest. This other group, the interest is 5%, so it's 105. Okay, everybody so far so good, huh? Okay, so we started off with 200 trillion. Now after a year, some of them leveraged, some of them didn't. So we end up with 625 trillion. Okay, okay. So basically, this money in excess of here, let's say for example, let's say, I want everybody now to pay me back whatever I lent out. I'm recalling every single cent that I have actually lent to you. Okay? So I'm going to go around collecting all this money. So fine. The people who have borrowed, the people who have leveraged it up, they say, fine, I no longer want my leverage. Okay? So fine, I'll take away your leverage. But I still have to pay the interest on the amount that was leveraged up, i.e. 25 trillion. This amount of these people here say, I borrowed from you 100 trillion for 1 year. Now, because of 5% interest, I have to return you 105. Okay, so these guys have to return 25 trillion more. These guys have to return 5 trillion more. So in total, everybody has to return $30 trillion worth of interest to me. Okay. The thing is this, if the amount of money supply in the world is 200 trillion, and I've collected that 200 trillion in terms of principal, i.e. I've lent you $100, I've taken back $100, I've lent you 100 trillion, I've taken back 100 trillion. But now there is an additional 25 trillion and 5 trillion, i.e. 30 trillion, that needs to be paid back to me. Where are the borrowers going to find that 30 trillion when there is only 200 trillion in the world? You get what I mean? So basically, this amount of interest that was created by charging a certain percentage on the principal, in terms of money circulating in the economy, does not exist. So the borrower himself or herself, no matter where he go and looks for the money, will not be able to find 25 plus 5, $30 trillion, because $30 trillion does not exist in the real economy. It was just an accounting, whatever, 5% and so on and so forth. But physically speaking, in terms of money supply, it is not there. So how in a balance sheet accounts assets and liabilities, if I have one side of it, my assets 200 trillion, and my liabilities, I have 230 trillion, because 30 trillion is the interest, how am I going to balance it? It's impossible. The only way I can balance it is to write off that 30 trillion or a large portion of it. And because when I write it off, then you'll find that my debit and credit will actually balance. Okay. And the write-off is the crisis, which means when you cannot pay, the bank takes a write-off. It cuts the debt away. Of course, it remembers, it sues you and takes your assets and whatever the case is, but it writes off the debt. So that is why this system itself, i.e. based on an interest system, creates what we call this amount of money which eventually cannot be repaid back because the money just does not exist. And therefore, in order for the balance sheet to balance, you get what we call write-offs, which are crises. And that's why if I go behind here, these crises are designed and inbuilt in the current system to happen every now and then because of the need to rebalance the balance sheet. Okay, a bit technical, but I hope I try and explain what it is. Okay. Okay. Lastly, before we go to the questions, what investment will do well? Well, we are telling our clients basically there are some investments which will still do pretty okay. Okay. Again, we're not trying to give investment advice, but giving you some education. So if you see this table itself, It shows some shares, Alphabet, Apple, these are very famous. They have a lot of cash on their balance sheet. Some of these probably won't be Sharia compliant, but they are very cash rich. That means they have a very strong cash flow. And they have a very strong balance sheet because they're all AA, AAA, and so on and so forth. So basically, these are the companies which we think will survive this kind of crisis because you have strong cash flow, strong balance sheet, and in some of these companies, you have very strong products. Yeah, so these are companies you do well. If you're looking for bonds or even sukuks, then you try and find those which have higher quality, AAA, AA. Sukuks also they have ratings also. Okay, so these ones will probably survive in a deleveraging environment, probably survive in an environment where there's a lot of defaults. Okay, and here, very hard to see, I know, don't worry, but this is just the what we call, we've all seen this. This is the curve for all the countries and stuff. Why did I put it here? Because I think countries which are at the bottom part, i.e. countries which have managed to handle the COVID kind of situation very well, Singapore, and yes, Singapore has handled it quite well, despite the fact we had a surge, but the surge mainly is due to clusters in the foreign workers' dormitories and stuff, but locally there's very little. Singapore, China, Taiwan, Korea. So these countries, if you find Singapore AAA, Taiwan AA, Korea AA, China single A, these are ratings. So they have very good A ratings. Plus, they've done they've mitigated COVID very well. So I think these economies may be able to come out much faster than everybody else. So again, that's one way of looking at it. Yeah. So good balance sheet, quality investments, people who handle the COVID situation well and are highly rated. Yeah? So these are just some examples of what I think will be good investments. Okay, so I'll just go back to the part here. Sorry. Okay, I'll start to call up some of the questions. Oops. Okay, I'll just have to scroll through. Do you think healthcare and agriculture industry will arise after? How about other? To be honest with you, I'm not sure, in a sense that the situation now is really, the visibility is very low. Somebody asked me also, what is this industry going to do well? Is that so? The answer to it is really depends, because it really depends on a few things. Whether there's onshoring, whether some of these industries disappear or they get gobbled up. Some, you know, it doesn't become effective anymore to have this kind of manufacturing. You know, some companies will never come back. That means, i.e., in this situation where they have suffered, no matter what you do, they will just not come back and start back again. And I think a lot of people don't realize that. Because really, give you an example, in terms of retail malls. Well, people now, because of the work from home, they're starting to, people who never ever use the computer to order things online or buy things online, they're doing it because they're forced to. And once you get the hang of it, it becomes addictive. and they're not going to go back in the same way again to a normal retail store again, because Amazon suits them, Shopee suits them, Lazada now is fine, it's, you know, convenient and stuff. Even the eateries itself, people are just going to order Grab food. So that's on a smaller scale where we could see some of this disruption being very severe and being fast forwarded because of COVID-19. And it could also happen in terms of sectorial. Okay. Sorry. As the nature of this recession is very different from the previous one, this is not only limited to one country or region, the US, and also suffering a lot. So how this recession is hitting economy differently and what chance change it will come with after. Yeah, I think I've answered that more or less. Meaning to say that I think, yeah, people shouldn't look at it as a normal recession. People should really, I'm an economist, and I can tell you that trying to model a normal recession is already very difficult. And that's why they say economists, when they try and model recessions, most of the time they get it wrong. Because trying to model recession, you take in variables which are, okay, historically what has happened. Not only that, now you have all these kind of linkages elsewhere. You got this thing going to China, this thing going to India, this thing. And how are you going to model that? It's going to be multi-variable models and so difficult. Okay, and that's just one country. when you talk about the whole world global economy closing down, shutting down for periods of time and stuff like that, you don't know what the impact will be after that. How are you going to model that? So I'm just telling you that really, you're right. It's going to be so difficult to model. So I think people who say the economy is going to recover in the second half of the year, or maybe early 2021, it's anybody's guess. My own feeling is because it's an unprecedented event, I tend to feel a little bit more bearish about it rather than bullish. Not that I want to, but it's just so much uncertainty. Okay. Oh, sorry. Maybe I should read from down. Is it scrolling up? Okay, I'll just go from. Okay, taking your suggestion approach of dollar cost averaging over 12 to 18 months, would it be easier to implement with unit trust and ETF than buying individual stock counters? Yes, good question. If you need to buy, we are saying that you should buy via a unit trust or ETF. It's not unbiased because I deal with unit trust and stuff. Because of defaults and bankruptcies will be so many, you run the risk of, if you buy one single share and you just make the wrong mistake and that share goes down, you lose everything. Okay, but if you buy a unit trust or ETF, you are actually diversifying over 30, 40 stocks or shares, and even if 2 or 3 of them go down, you're not hit. Okay, so you will actually mitigate your default risk by buying into a unit trust or ETF. Okay, crude oil is 1750. Markets impact, black swan event, QE. Okay, let's quick one. First one, crude oil. It is going to hit countries like Malaysia because Malaysia depends on revenue for oil revenue. Malaysia actually budgeted about $70 per barrel last year. Now it's only 17. Its cost of production, I think, is about 18 or 19. So it's going to be tight because revenue has evaporated that it wanted to use is no longer there. Okay, but again, to be fair to Malaysia, a lot of other countries which are oil exporters will feel the same pinch. Okay, so and oil won't recover that fast because why? We already have news. You can Google it in Bloomberg that the oil storage are filling up so fast that in a couple of months there will be no longer any more oil storage to put the oil that the refineries are pumping out. And to shut down refineries is not easy. It takes time. So what they're saying is that, you know, with all the onshore tank storage are all full. All the tankers which are sitting offshore that we fill up the oil in order to put storage there temporarily, they are getting full also. Where are we going to put our oil? I mean, I think the industry has never ever thought of that this problem will ever arise, but it is potentially arising. So I think potentially they'll start switching off all the refineries. Then, you know, oil now is a demand and supply thing. Demand has collapsed. Supply is just massive. Even if demand picks up, the first thing they need to clear is they need to clear all the excessive supply. That will take time. So again, I don't think prices will run up extremely high very fast. Okay. Can QE buy into non-investment grade corporate bonds? Yes, they've done it already. Central Bank, the Federal Reserve has started to buy high yield ETFs. So they are involved in the high yield space already. What is your view on the next phase of trade war between US and China? We're not sure. I think it will get worse. That's my own view because already they are starting to fight even before COVID finishes. US accusing China of hiding the data and stuff like that and things like that. I think a lot of countries will now realize strategically I cannot leave certain industries in China. Ventilators, masks, everybody is going back to China, kowtowing to China. I need it. And China is now saying, yeah, you see, you want to do trade war with me? At the end of the day, you come back on your knees to me. I mean, that kind of situation. So I think now there could be a rethink of a lot of these things, plus the onshoring, which would actually bring back a lot of things. So there could be this huge trade friction, nationalistic kind of situation, you know, that's going to come up. So globalization is in reverse, so to say. Donald Trump, yeah. So Donald Trump itself, yeah, he's going to do anything and everything to win the election. So don't be surprised. But this thing has really hit him hard. So let's wait and see. Okay. Sorry. me see whether you see fiscal policies. Fiscal policies are not a powerful tool anymore, unfortunately, because of that. See, all the governments have just introduced their COVID-19 packages. Straight away, the rating agencies have cut their ratings. That goes to show that fiscal policy is limited. That means the more you do, the more your ratings suffer, and there are consequences of it. Meaning to say that when your ratings go down, you go out to the market to try and borrow money by issuing either sukuk or even conventional bonds, your government bonds, then you will be penalized with higher interest rates. Okay, there could be a liquidity trap. Yes, I won't go in. I mean, it's a bit technical. We can discuss it because I think a lot of people here may not understand liquidity trap. But true enough, in fact, there was a liquidity trap already in the past 10 years, because if you look at the velocity of money, despite the fact there was a lot of money in the US, people were not churning that money. The velocity was very low. Therefore, it was non-inflationary and so on and so forth. Okay. Yes, I think it's a good time for real asset, except for example, real estate. The problem with real estate is being leveraged up. It has been leveraged up so many times over the past couple of years that now it may suffer from the deleveraging effect. Gold has not really been leveraged up. Gold has always not been that kind of thing where you leverage and so on and so forth. Okay, so I have a video on gold. Please have a look at that. I think gold is one of the things to own in this kind of environment. Okay. Sorry. Just go have answered this also. Okay, touching on Sharia funds, do you foresee a global sukuk index to fall further than high yield because of fall in oil price? Okay, that's a good point, because like I mentioned, the Middle East sukuks, which are already, most of them are in non-investment grade, could come under pressure because most of these countries are dependent on oil for revenue. Okay, so you have a situation where these Middle East sukuks will come under a bit more pressure. Unfortunately, because if you're a fund, you typically buy both the ASEAN sukuks and the Middle East sukuks. So your fund has both. So if the Middle East ones become weaker, then your funds also may have some downside pressure. And even in the ASEAN space, only the Malaysians probably have a better chance, even though I mentioned just now with regards to their financial situation or fiscal situation. Because when you look at other countries who are sukuk issuers like Indonesia, I also worry about them. Because again, the situation could be very bad. They would need to raise money, their COVID pandemic bonds and stuff like that. So that will hit their ratings and so on. So it's not a pretty picture, not only for sukuk, but across the world for bonds. And that's why for ourselves, on the non-Sharia compliance side, we are asking clients to move to the front end, short duration, money market type. Unfortunately, there's not many in the Sharia space because we only have sukuks, and sukuks are basically 4 or 5 year duration. So when you push to the front end, basically we're talking about things like Islamic money market. In Malaysia, you have it, not in Singapore. In Singapore, probably just the Islamic fixed deposit type of funds. Okay. Do I see a time where the Islamic products will lead traditional financial products someday? It's already happening. It's just that it's not called Islamic financial. It's not called Islamic products. It's called ESG products. It's called ethical products and stuff. Those are really Islamic products in a sense. Of course, there are different types of overlays and stuff like that. And sometimes I feel, for the lack of a better word, they are even more, inverted commas, let's say Islamic than some Islamic funds. In a sense, okay? Don't quote me verbatim, but let me explain first. Some ESG fund, most ESG funds will not buy into fossil fuel companies. They will not buy into companies which they think are detrimental to the environment. They will not buy into companies which governance is an issue. Okay. Question is, do our Islamic filters, by and large, some may, by and large, take that into account? Do we still find fossil fuel companies in some of our Islamic funds? Do we still find companies which destroy the environment in our Islamic funds, do we still find companies which may have governance issues in our Islamic funds? Because if we still find them there, then that's why I'm saying I think our Islamic funds may, the way we screen, the way we filter may have to change, because these are really issues which I think the Islamic side should take into account. Okay, so I don't have the full, like, what are the filters and stuff like that. So I do apologize. Some rule books may take them into account, and I think that's excellent. But for those who don't and just merely depend on general business activity and a few other ratios, and you're fine, you're Islamic, I think those needs to be tightened up. Okay. Sorry, just call this up. Okay. If you were to invest today, what is the best industry? I think I've gone through that just now. I've showed you in one of the last slides. Okay. What will happen when the Fed starts buying stock? Then I would also start buying stocks. If the Federal Reserve, and this is really a debate that's going on in the finance world now, if the Federal Reserve, which with its huge amount of injection of unlimited infinity quantitative easing, coupled with a stock buying rule coming in now, playbook, and they managed to actually bring the market up, and it's a sustained move, okay? That will send a very strong signal that the Federal Reserve can actually prevent what would potentially be a great recession, a greater recession, or even a depression. They have succeeded in flattening the recession curve or depression curve. Then the question is, if they can do that for such a situation where half the world is closed, or maybe 90% of the world is closed, and they can succeed in doing that, there's nothing that they cannot succeed in turning around. Normal recessions are no longer recessions anymore. You get what I mean? Because if they can turn this around, they can turn anything around. So then the debate would then move on to any normal recession, no problem, Federal Reserve can handle. So the next debate will be, how big will the market allow the Federal Reserve balance sheet to grow until the market starts punishing the Federal Reserve for having such a big balance sheet? Yeah, so that will be the other debate. We haven't reached that point where we're having this full-fledged debate on this issue, but that's, I think, slowly growing. Okay. Derivatives also magnify the scale of market meltdown. Yes, is Islamic finance communicating to the world effectively to drop derivative products? Which will that ever happen? Warren Buffett calls derivatives the weapon of mass destruction. Unfortunately, derivatives will always be around. They have a function in the conventional world and stuff like that. You know, forwards for hedging purposes and stuff. Maybe we haven't had that blow up in derivatives yet. Maybe it could be this particular crisis, I'm not sure. Unfortunately, we will have to have a blow up in derivatives in order for governments to come and step in, and central banks to step in to say that, okay, we need to control this. Very much like how we had the US government come in and tie the hands of investment banks after the Lehman crisis and so on and so forth. So you will need actually a blow up for this to happen. So unfortunately, that blow up will be, again, devastating to everybody. I'm sorry, I don't have the view on the ETFs. I do apologize. Okay, has shown deep cracks in the developed countries' healthcare preparedness. Correct. Do you see any move away from currencies? I don't. Okay, so it's two totally different questions, right? One is regarding the healthcare preparedness and currencies and currency packs and stuff like that. We could be. One of the swans, whether it's black or gray, could be we could have a currency situation. I won't call it a crisis. We could have a currency situation because, like I mentioned to you, when countries want to prop up their economies, they do interest rates. They cut interest rates. With many interest rates almost down to zero, you can't do anything else. They try and increase their fiscal spending, and now you increase, you get whacked by ratings. Okay. What's left actually is to actually promote a devaluation of your currency. And we all know that when one country devaluates their currency, everybody else devaluates in what we call a currency war. So that is certainly what we call a gray swan or even a black swan, which potentially, I don't even a gray, I would say a gray swan, because when you run out of instruments, central banks and governments could move to that last instrument, which is actually intentionally weakening their currencies. Okay. Are you able to explain and what to expect for the recession? I think I've marked that out in some of my slides, a deep decline and stuff. So really, as an individual, as a household, you really have to have that kind of hunkering down mentality. I would say don't think that this is going to be a short-term thing. Think emergency, think conservatively, conserve and stuff. Some people say, oh, in that case, if you're not going to spend, the economy is not going to pick up, and so on and so forth. My understanding or my theory is different. I think we are entering into a very bad situation. It could actually lead to a recession similar to the Great Depression. We don't know. Right now, everybody's in agreement. It's going to be worse than 2008, but we don't know whether it's going to be similar to 1929. So it's falling somewhere in between there. Where it falls in between is left to be seen. Okay, so you ought not to be taking too much risks. You ought to be a bit more conservative, in my view, in all the things that you do. Okay, is there a risk of a great war in the next decade? I laugh, but then inside I'm also worried, because again, these kind of things perpetuate what we call, when it becomes nationalism. We've seen a lot of dictators coming out in Brazil, in the U.S., in I think Czechoslovakia, or not Czechoslovakia, in Poland or somewhere, Hungary. So again, this crisis will lead to discontent and potentially could actually lead to conflict. There's one theory brought up by Rubini. Rubini is an economist who's quite famous. You can Google his name. He is almost certain that there is going to be a war between Iran and the US. Okay, again, this is not my saying. I'm just telling you what he's saying. Why? He's saying that the sanctions on Iran is so severe that Tehran cannot take another 4 years of these sanctions. Okay, and if Trump is re-elected, the sanctions will continue for 4 years. So Tehran will try and create proxy wars and disruptions in order to undermine Trump's election campaign or re-election. Because historically, when they look at all the wars that the US have been in, from the Vietnam War, the World War II and stuff, every time there's a war, the incumbent president doesn't get re-elected. This is, again, I've not checked it. This is what so the theory is that his theory is that if they create chaos and stuff like that, there's a lesser chance of Trump being re-elected, and maybe Joe Biden or whatever will not follow through on this tough Iranian sanctions. So better chance of it getting lifted. Again, that is theory, but it could make a bit of sense. Okay. Dinar, dirham and stuff like that. My view has always been that, the scholars accept fiat currency from the perspective of that is the currency that's being used today. Okay. My view is that dinar, dirham, the thing that we can take, it's going to be very hard for dinar, dirham to come back and replace fiat currencies. Okay, it may take time, it may happen, inshallah, we don't know. It's much easier for fiat currencies to move a step back from where they came from, which is prior to the so-called what's that called, 1970, 1971, what accord? I can't remember, it's on the top of my head, it's not the Plaza Accord. Bretton Woods, yes. Prior to Bretton Woods, currencies were pegged against gold. Okay, so that's very much like a dinar dirham situation. It's just that we're not using physical gold, we're using currencies which are backed by gold. Okay, so it's easier for that happening than to just adopt a so-called physical dinar dirham. Okay, what's also easy is when we come to a point where there is this discussion about central banks printing too much money and becomes inflationary and so on and so forth, maybe there could be rules coming out to say that central banks, you cannot print money as much as you like. There is a cap on the amount of money that you print. That then takes a major characteristics from gold, because when you look at gold, you will realize that it's not only the fact that gold has an intrinsic value, it's the fact that gold is limited in supply. And that is why gold has always been this store of value, because you just cannot go and create as much gold as you want. So that characteristics of limited supply of gold, when you take that and you apply it to fiat currencies, I think that will be the first excellent step towards maybe eventually having dinar, dirham, whatever, but that itself would stabilize the fiat currencies, because right now it is just basically going berserk. Okay, from the, as you can see, the Federal Reserve is just printing and printing and printing. There are repercussions to that, and I hate to say it will be not a nice situation. Okay. Malaysia recommends a steady economy rather than an overheating economy. Why US do raise, print more money and force GDP growth and common man is not getting rich? Simple answer to that is governments only look 4 years ahead, 5 years ahead. They just want to be re-elected, and basically, like Trump today now, the economy needs to get back on the footing, and he doesn't have much time, because when people go to the poll, they need to feel good. So basically, that is why governments elect to do all these things, which will bring short-term gains, okay, but it will make the next generation suffer, okay. The Federal Reserve, in my view, and many central banks who adopt quantitative easing, is just kicking the can down the road. We should have had a recession in 2016. We should have had a deeper recession in 2008. Okay, because recessions take away the bubbles. Instead, when you try and stop a recession halfway through, or try and even prevent a recession, the bubble remains and only gets bigger. And that's when this chart I showed you today, the bubbles are just so big that the Federal Reserve, instead of saying, I actually should allow this bubble to decline, is now saying, I cannot allow this bubble to decline, because if I do, a lot of things are just going to suffer, the economy is going to collapse. So it has created its own negative loop, whereby it has to support this monster that it has created, unfortunately. Okay. Yes, I do think the digital currency adoption will be accelerated. Okay. Investment in cryptocurrency, I'm sorry, I can't give advice on that, on cryptocurrency, but I can just merely say, I can say that cryptocurrencies will at some point become an asset class. Even if it's not now, it will come as an asset class of its own. Okay, so the full adoption of cryptocurrency, I think it's just a matter of time. Yeah, but I'm not going to say which one and so on and so forth, because I'm not an expert in that field. Okay. A few more questions. Sorry. With regards to 2021 economic outlook for ASEAN, do you see quickly recover? It depends, you know. ASEAN today, we have quite a few ASEAN countries which are very weak fiscally. So they're not going to recover as fast as maybe Singapore. Singapore's advantage is Singapore has reserves, which it can spend without affecting its ratings and stuff like that. And some of these ASEAN countries, they depend on FDIs, foreign direct investment. So if there's onshoring, what will happen is you'll see a lot of foreign companies pulling out and going back to Europe, going back to the US. What ASEAN really needs to do is make sure that this ASEAN economic bloc comes together fast in a united way. We've always had it, the bloc is there. But I don't think the bloc has been, there wasn't a push factor to make it really something which is like, you know, urgent, but now the urgency is there. The barriers between countries have to be removed in order to promote, because again, many of these countries are designed for export orientated. Malaysia, Thailand, even the Philippines and Indonesia and stuff like that. If other countries are not importing anymore, where are you going to sell your goods? So ASEAN and maybe a few countries, maybe like Australia, New Zealand, come together, need to create and to ensure that, well, there is no globalization on a global scale, there's still globalization on a regional scale. Okay. Would it be wise to sell on bear rallies given your base? I would think it's a DCA would do well. I mean, if you, the people who are buying and selling today are the people who trade the market. Okay, because they're two different. They're traders and they're long-term investors. If you're trading the market, market goes up, you sell, market comes down, you buy, because you want to trade the range and stuff like that. Okay, because right now we're in the range. If you are looking to establish what we call a foothold, a lower average, a buy-in price, you can do two things. Either you want to wait, think that I'm right, market comes down, and then you buy the bottom or you buy near to the bottom. Then you would have, that is called market timing. If you're like me, I don't know whether I'm right, 30% up, 70% down, I'm not sure. One of the safest way of doing it is to do the dollar cost averaging, because again, I also admit I don't know where the bottom is. So dollar cost averaging helps to take out that, you don't know where the bottom is, but you actually get some money in the market. If you do DCA and let's say you do 2-3 DCA and suddenly the market starts to turn up. If you are in a DCA, at least you got 2 or 3 bullets in, and then you start to like, okay, maybe now I can just jump on. But if you're not under DCA, you have nothing in. And when you have nothing in, that's the worst thing, because market goes up, you're telling yourself, should I wait for the market to come down before going up again? And then the market never comes down, and then you start waiting and waiting, and then at the end of the day, you miss that whole big move. Okay, so dollar cost actually allows you to be in tune and in line with the market by moving in a little bit. Market goes up, you have some money in. Market goes down, never mind, I've not used up all my bullets yet. Okay. Rising populism, yes, rising. That was what I mentioned. Rising populism will aggravate further. Onshoring crisis. Will Indonesia riot again? I mean, I pray and hope not. But one of the things which I was extremely worried about is this COVID situation, because if Indonesia doesn't confine and deal with the COVID situation well, and this thing spreads, you know, food shortages and stuff, these are things which are, it could happen, you know, and that's why personally also, you know, I've been getting donations to send over to Indonesia, to send over to Malaysia and stuff like that, to buy PPEs, because this is something which you just cannot say it's I need to deal with the problem myself and I can ignore everybody else. This is something with, if instability is in Indonesia or even in Malaysia, you will find that there are repercussions and spillovers. So you need to deal with it in those countries. So the short answer to that is, I hope not. I don't think so. But like I say, if a crisis happens, I don't know. China is reducing the dollar reserves of buying real estate in the US. Will the world ever move away from dollar for a new reserve currency? Gradually it is, but it will take really a long time. Until everybody is in agreement not to denominate and invoice their goods in dollar terms, then it will happen. But until you do so, you know, everybody was saying, oh, we're moving away from dollar, This recent crisis in March, the dollar squeeze was so bad that people were scrambling and looking for dollars. And it caused the dollar to just way sky high. Why were people scrambling for dollars? Because you know what? Over the past 10 years, countries outside of the US were issuing bonds in US dollars. Because the US dollars the rates were low, and people like to borrow in dollars most of the time, okay, because they have what we call obligations in dollars. Countries also have obligation in dollars, and they can shore up their reserves and stuff. So they were borrowing in dollars. The amount of bonds that are being issued over the past 10 years, the coupons on these US dollar bonds in aggregate is $13 trillion a year, if I remember the number correctly. So without doing anything, these dollar-denominated bonds issued by countries outside of the US will need to find 13 trillion worth of US dollars every year to pay coupons. Not even principal, just coupons. And that itself is a flaw to US dollar demand. So how can you get rid of the US dollar when countries themselves are issuing bonds in US dollars and requiring US dollars? Until they stop doing so, then we have a chance of moving into a new reserve currency. Otherwise, it's difficult. With DCA fees associated with increase, would the profits be justifiable? Well, DCA, the fees on DCA, well, I think we need to take that outside of this discussion. There's whether an ETF is more better, whether unit trusts are not. I mean, we can have a long discussion and debate on that. I would welcome Jeffrey, right? Jeffrey or Jeremy to Juari to actually contact me, and then we can have that kind of try and understand more what your scenario, then we can talk about that. Okay. My articles you can find on the videos. The videos are I think it tells you a lot of what I'm thinking about, especially in this period. Yeah. So please go to the YouTube and like the YouTube channel to follow the videos. You get a lot from there. Okay. Ridwan, have I missed out on anything? It's just that yeah, please highlight to me if I've missed out anything.
I think we'll continue. We'll bring the questions to offline and then pass it to you.
Okay, yes. What time is it? Sorry, my apologies. I don't know what time is it also.
10:55.
Oh, okay.
Yeah,
okay.
it's okay.
Yeah, so I think
it's almost 10, but I think you've answered most of it.
Okay.
Yeah.
So I apologize. We have the questions, right? So questions we have. Basically, what we can do is maybe I can put in a video. If I can do that, I'll put it on the YouTube. Or maybe we can also go back to some of these people who have posted the questions. And you have my email, and you can always email me if you feel that there's a delay or I didn't answer your questions. Okay. So I do apologize if I went over time. I tend to talk a lot. I apologize if there's anything I said which was inappropriate and stuff like that. Do forgive me. I hope I've imparted some knowledge to you and given you some of my thinking. Again, I cannot be 100% right, so please be aware of that. And I hope that yeah, we will meet again, and like I said, do subscribe to the YouTube where you will find more and more things that I will post there. Otherwise, I thank you very much, and I leave by saying Assalamualaikum wabillahi taufiq. Assalamualaikum warahmatullahi wabarakatuh. Okay. So Ridwan, are you taking over or?
Yep.
Okay.
We'll just end the call. Thank you everybody for listening in. And thank you so much, Mr. Sani. It was very insightful. I'll definitely watch the recording again.
Okay.
All right. Thank you, everybody, and take care.
Okay.
Stay safe.
Okay.
Assalamualaikum.
Waalaikumsalam warahmatullahi wabarakatuh.